Good afternoon, everyone. I want to welcome you to our new webinar, Finding the Right Balance for 2021. Today, I will be acting as the co-presenter of this webinar. I'm the Chief Investment Officer and Head of Asset Management at Jesmond Midzi Financial Advisor. In today's agenda, I will explore with you the current macroeconomic context, especially after we witnessed the recent trajectory of the US Treasury 10 years by reaching 1.7, a major issue for the bond market and for some specific sectors in the equity market. Our narrative will bring us back to 2020, especially to March 2020. The second part of the presentations will be covered by Marc Azzopardi, co-portfolio manager. He's a partner and founder of Jesmond Midzi Financial Advisor. The company has 18 years of existence. Marc will guide you on our holding and our core convictions for the high-yield market. A quick introduction of Merrill investors, if it's the first time with us. In 2020, we spoke about our strong convictions, Asian economic resilience, semiconductor dominance, and an energy transition. So far, in 2021, we had two webinars, one on the high-yield market located in the northern part of Europe, and a second webinar which provides you with insight on a specific topic as artificial intelligence and machine learning. If you wish to know more about us, I invite you to visit our website. Let's start the presentation.
Let's start with the performance of the strategic balance. In 2020, the performance was plus 4.15%. Now, from a one-year perspective, annualized the performance was plus 9.25%.
This investment process will be present at the bottom left of every slide of my part, as an indicator for you to know if we speak about macroeconomy, valuations, market timing, or market sentiment. Let me give you a quick description. On the top left corner, macroeconomic factors, which are the top of our universe, surrounding the other parameters. No doubt that the central banks around the world have been playing a key role to keep the global economy floating above the surface. We'll come back in detail in the next slide for few figures as industrial productions level, pre-COVID and now. Now on the second, at the top right corner, fundamentals and valuation factors, definitely something to consider as the US market is expensive by using traditional metrics as price to earning or other valuation metrics, particularly if you want to compare with the Asian market or the European market. On the bottom left corner, market timing, an essential element to find the right windows to buy and obviously to sell. And to finish, on the bottom right, market sentiment, which is rotating at a fast speed at the moment. We could use put-call ratio, VIX, or social media. And to finish these investment process descriptions, the core sphere is our portfolio constructions. Now, let's have a view about our current allocations. We can split in 5 segments, which are from the top, high-yield bonds, cash, equity, investment-grade bonds, and finally sovereigns. The narrative here took place on March 23rd when Jerome Powell, chairman of the Fed, said that he will support the market by using his monetary arsenal as quantitative easing by loading the Fed balance sheet at unprecedented level. Back at that time, we made a major shift in our asset allocations by a reduction of, first, our sovereign exposure. The majority of our exposure was in Treasury or supranational rated AAA. Second, it was our cash exposure that we reduced to 3 to 5 zone. Now, March sell-off was offering us an incredible opportunity to double our exposure in the investment-grade space, which was expensive back at that time. The risk and return profile was not interesting before March 2020, especially for euro-denominated bonds. For us, in 2020, the second major event took place at the end of October when the reflation trade started around the globe. It was our second major shift in our asset allocation for 2020 in the directions of high-yield bonds. What I would like to highlight that we initiate an increase in the direction of high-yield bonds in a specific segment by avoiding oil companies. Marc Azzopardi will go in detail in the second part of the presentation. In 2020, our exposure to investment grade and high yield was double, and our sovereign was reduced by half. Just to summarize and simplify the sequence, two major shifts, one in March related to Fed interventions, and one in October-November related to reflation trade around the globe. We witness a sector rotation from growth to value there. Let me guide you now on a very interesting fact, Sharpe ratio. If you remember, during our last webinar in February dedicated to the segment of the Nordic high yield, we mentioned in the presentation the Sharpe ratio per asset on a year-to-date basis, and the high yield was at the top. In the current setup, energy, financial, and Bitcoin are at the top. What is interesting at the moment, investment grade has a negative Sharpe ratio, which is worse compared to the 10-year Treasury. We'll come back to this fact in the next slide. One interpretation to explain this trajectory in the short term, it's no major correction took place and volatility remains low. I'm not here to debate that Bitcoin and energy are offering an incredible risk-return profile, but because why? They are outside of our current mandate. So for us, they're outside of the scope. My point here, the market sentiment is positive in the direction of high yield. It remains an attractive asset class. Two major factors to explain the attractiveness of the high yield should remain in the developed world, a low level of bankruptcy and a dovish tone from the central bank here to stay probably until 2023. Now, on the next slide, as we can see, this is our allocations more in detail, and I put pre-COVID and current allocations. So sovereign, we started at 51%, we are now at 18%. Investment grade, we started at 20, and now we are at 36. For the high yield, we started at 8, and now we are around 19. Equity, we start at 3%, and now we are at 23%. Now, really interesting fact, as you can see here, LQD, TLT, and GNK. What you can see at the top here, it's a certain resilience of the high yield bonds versus investment grade versus treasuries. As you can see, the black line is the long-term treasuries. So quite an interesting correction took place, I will say, at the beginning of January. So let's discuss in line with the slide. Let's take a moment to discuss major indicator from pre-COVID and now. We can separate in two categories, macro and market. We can notice a stronger recovery for US PMI, or if you prefer, industrial productions on the macro side, and on the market side, a nice positive trend for the S&P 500, energy and Bitcoin. In the same period, gold remained flat. It looked like in general we are in a better shape now from a macro and a market perspective. The incredible response of the central banks to the pandemic could explain this situation, even if we know that people are struggling against the pandemic on a day-to-day. Now, regarding our high yield allocations, let's explore on the next page. I would like to spend some time on our currency breakdown for our bonds. My approach is similar to the previous slide with a comparison between pre-COVID and our current allocations. Let's see more in detail. Our dollar exposure started at 63%, now we are at 38%. Our euro exposure started at 8%, now we are at 29%. Our Norwegian krone exposure, we started at 3 and now we are at 3. Our Singapore exposure started at 0, now we are at 3%. Our hedging philosophy here, we do an active hedge for the euro-dollar exposure, knowing the fact that we are dollar-based. Norwegian krone and Singapore dollar, there is no hedge in place because we don't have intentions to hedge. It's an active currency base. For the Norwegian krone, for example, we have appreciated the fact that the positioning of the Norwegian central bank with more ammunition compared to the European Central Bank, the rates are not in a negative territory. We can apply a similar concept for the Singapore dollar with the positioning of the Monetary Authority of Singapore and more ammunition due to the positive rate. What is important also for us, the strategic location of Singapore in Asia, a safe place to park money, particularly for private investors and a boom of the private banking there. Now, let's go back to our dollar exposure on the next page. Here, as you can see, we have been quite active in our hedging approach, especially since March 2020. In red, our entry point, and in green, our exit point. Now, no doubt that the dollar is on a downtrend since March 2020. However, since the beginning of 2021, the downturn has stopped in conjunction with the US Treasury spike. As you can see, since the beginning of 2020, we move our hedging ratio from 90 to now 70%. Now, as we mentioned earlier, the downtrend of the dollar has stopped at the beginning of 2021. You can observe on the chart the trajectory of the US Treasury moving from a bottom at 0.5 to now at 1.7. Now you can observe on the chart at the bottom the trajectory of the spread between the US 30 years and the 5 years moving from a bottom of 60 basis points to now 160 basis points, a clear steepening of the US curve. An important element to mention, we cut at zero our long-dated exposure to Treasury as we sold our Treasury 2050 and 2049 in November to reduce our durations. We were preventive by reducing the sensitivity of our bond portfolio. Now, one important element and explanations of this trajectory of the rate, the G10 inflation surprise index is at the top, back to a level never seen since the end of 2016 and 2017. Now, it is, on this next slide, it's not a surprise to see the positive beta of the consumer price index for the commodity complex. And we can rank at the top energy, following by agricultures and base metal, and finally precious metal. As we know, gold is struggling at the moment and lost a lot of traction in favor of digital assets like Bitcoin. We can see here a positive beta to CPI for the high yield and the S&P 500. Marc will explore with you in the second part one of our holdings present in the high yield bond. This company is active on the agricultural business, a clear beneficiary. On the other side, and to finish there, on the other side of the spectrum, the US Treasury, and especially the US Treasury long dated, had a negative impact to the CPI, as expected. Now, here, another interesting characteristic present after the spike of the US 10-year Treasuries, the bond volatility is going out on the opposite direction. In conclusion, not the best environment for Treasury, and especially for long-term Treasury. As we mentioned before, a nice market configuration for the high-yield bond segment, especially for companies which have an exposure to the commodity complex. Back to our allocations, we found the right balance in this environment as we reduced by half our exposure to Treasury and we double our exposure to high yield. As we said before, we have been reducing drastically the duration, especially on our Treasury exposure. Now, on that slide, you can observe the trajectory of the Greek 10 years in green since 2019, and on the other line represent the US 10-year Treasury. What a divergence which took place in 2020 on the third quarter. The question is, you wish to put your money in Greece for the next 10 years at 0.8 or in US? It's an open question. Now, let's take a moment to discuss the relations between the yield and the equity market. The black line, the negative correlations has increased between the yield and the software company present in the S&P 500 in 2020 and in 2021. The green line, the semiconductors, one of our top convictions. The correlation is now neutral. It was positive before. It is important for us to know this relationship as we have around 70% in bonds and 23% in equity. We wish to preserve the equity part, especially as we experience a yield shock on the bond part. Finding the right balance is key to establish harmony across our different assets. To finish the sections on the yield, I want to provide you the structures of the US denominated bond market in opposition to the structures of the euro denominated bond market. At the top, leverage loan, high yield corporate, and emerging market. At the bottom, US Treasury, 1 to 3 years. The structure is quite well diversified and by segment and by size. The spectrum is large, probably one of the reasons why the investor appreciate this market. Now, on the next page, here, this is the European structures. At the top, AT1 or COCO if you prefer, high yield, and at the bottom, collateralized bonds. The structures is highly concentrated on the sovereign segment, as we can see. Back to the AT1, by choice, as we remain conservative in this mandate, we have limited our exposure to AT1 only to the Nordic banks. We know that in the South Zone, we have an attractive coupon there. However, we keep in mind that we are not out of the pandemic, and if another summer will be missed for the touristic countries as Spain, Italy, it will be very difficult for the economy due to the absence of cash flows. Northern of Europe is more industrial and for us more resilient. Now, let me finish the section here with one of our favorite thematic in 2020 and 2021, Asia. We remain convinced that the growth capacity is present there and for the next decade to come. The reason why we continue to balance in these directions, China will reach its target of 6%. And on the next slide, as you can see, this is the trajectory of the industrial productions and the retail sales in China. I will say Asia is starting to go back to normality here. But Europe, we are still far away, unfortunately. That's the sad reality. Now, I will go on another interesting fact. As you can see here, this is the MSCI emerging market. As you can see, Asia represents nearly 81%. So, as we can see, Asia is dominant. Now, I would like to speak about an interesting fact. We are now facing a retail army. Retail trading now is equivalent to the mutual funds and the hedge funds combined in terms of volume. An unprecedented situation, I would say. I cannot finish my part without mentioning something very important coming from the Biden administration, a massive fiscal stimulus will take place at the end of March. We will see. I would like to thank you for your attention. Marc will guide you for the second part. Thanks again, and hope to see you again in our webinar as we will continue to provide you insight. Please, Marc, the presentation is yours now. Thank you.
Thank you, Marc. Hi, everyone. In the next few minutes, I will try to cover a couple of holdings we currently hold in our MERI Strategic Balanced Fund. Before I kick off with our first name, I would like to pinpoint some key important aspects in our stock selection. As I highlighted in our Bright Talk session back in November, we favor issuers operating in sectors, regions, currencies that are likely to provide the highest returns in the prevailing scenario. And most importantly, we avoid industries that are more cash burners and favor sectors that have a predictable and sustainable free cash flow. So, our first name for today is SEB Group. SEB Group is a leading Nordic financial services group based in Sweden, founded in 1856, with over 4.4 million customers around the world. The bank's operations are divided into 4 business segments: merchant banking, retail banking, wealth management, and life segment. This group is in our list of approved issuers as it has a corporate clients queue across Northern Europe, which supports its 2021 earnings prospects, supported by upbeat loan demand and a robust deposit margin. This backdrop should ensure the bank retaining near sector-leading revenue growth. More importantly, especially for the paper we hold, the group has a sector-high CET1 ratio of 21%. This offers a large buffer of 840 basis points over the requirement. We currently hold the AT1 denominated in US dollars, with a first call May 2025. We entered this position in December 2019 with a yield of over 4.9%. Today, spreads have tightened. However, we are still remunerated for the risk, backed by the strong fundamentals of the group. We also hold the Tier 3 maturing in 2029 in euro. Here spreads have tightened by 30 basis points and the pricing of this paper is verging towards the expensive side. However, these yields may be supported should the earnings prospects of 2021 were to materialize. Moving on to our second name, it's Olam International, which is headquartered in Singapore, and Temasek Holdings, the sovereign wealth fund, owns 54%. Olam is a fully integrated supply chain manager and processor of agricultural products and food ingredients. The company operates through 5 segments: edible nuts, spices and vegetable ingredients, confectionery and beverage ingredients, food staples and packaged foods, industrial raw materials, ag logistics and infrastructure, and commodity financial services. The company has operations across approximately 20 platforms in over 70 countries. We like this company and credit because this group has shown that its business model is quite resilient, reporting strong results despite COVID-19 challenges. In actual fact, it reported growth in revenue in 2020, ending with a strong cash position and a moderate gearing of 1.72 times. We hold the Olam 5 3/8 SPERP with a first call date 2026 in Singapore dollar. And as Marc showed earlier on, this is an active currency position. We entered this bond in its first trading days of trading in January of this year, with a yield of 5.54%. With current prices, this is currently yielding around 4.9%. Our third name for today's session is Eurofin. Eurofin is the world leader in food, environmental, pharmaceutical and cosmetic product testing, and in agroscience contract research services. We like Eurofin as it has showed a sustainable growth in revenue with a 5-year compound annual growth rate of 23%, an adjusted EBITDA of 31%, and net operating cash flow of 33%. Thanks to a fast-paced response to COVID-19 and the resilience of its core businesses, Eurofin delivered very strong full-year 2020 results. In terms of revenue, they're up by 19.2%, adjusted EBITDA margin up to 26%, and cash flow up by 143%. The year-end net debt decreased to 2.24 billion from 3.24 billion in 2019, thanks to the strong cash flow generation and the successful equity issuance in May 2020. As a result, the leverage ratio decreased to 1.6 times from 3.2 times at the end of 2019. We currently hold the 2 7/8 SPERP in euro with a first call 2022. We bought this paper in 2019 with a yield of over 2.9%. Since then, spreads have tightened and the yield to call is around 84 basis points. Considering the improved financials with a first call in 2022 and the high step-up, we feel we are still remunerated for the risk. We also hold the 3 1/4 PERP in euro with a first call 2025, bought in August 2020. With a yield of 3.2%, the yield today is around 1.75%, and similar to the previous paper, we feel that with the current spread, we are still remunerated for the risk. Moving on to our last name, in this case it is an equity position which we consider as a potential source of alpha. It's Leroy Seafood. Leroy Seafood is a world-leading seafood company with roots dating back to 1899. It is a fully integrated company with control and management of an entire range of seafood products from sea to consumer. And this is true within product development, logistics, and distribution. It is based in Bergen. However, it engages in fishing and aquaculture along the entire coast of Norway. LEROY has factories that produce and package in Norway, Sweden, Denmark, Finland, France, the Netherlands, Portugal, Spain, and Turkey. The outlook for salmon prices in 2021 has brightened, given expectations for slower industry supply growth. LEROY's farming revenue may strengthen beyond 2021 and could rise the next few years as its harvests continue to hit new records. Farming profitability should improve as production yields rise. LEROY's results were better than estimated, and the company raised the dividend, which buoyed the share price. We entered this position in May 2020 and added to this position in June and July, with an average price of approximately 55 Norwegian krona, and it is currently trading in the region of the 72 NOK. That brings us to the end of today's session. For more information, one can visit our website merillfunds.com, and you may also download the attachments found on BrightTalk. Thank you all for attending this presentation, and if you have any questions, please email us on assetmanagement@jasminemitseed.com. Thank you once again.